Hey guys, good evening, good morning, good afternoon. Can you please confirm if the audio video here is all right? Can you please confirm if the audio video is okay? All right then. Hi Lavina. Give me a minute, sorry. Okay. Hi Lavina, Rohit, Karan, Somyajit. Swapnil, how's it going, guys? Interesting times to study more stock markets these days. A lot of mixed signals, no clarity in terms of which direction the markets are headed. Hi Abdul, hi Shri Lakshmi. This is the session number 3 of financial modeling. That's right. Today's a comprehensive session where we kind of do, the income statement and balance sheet together, and then we do some sort of a ratio analysis. Volatility sucks for maybe long-term investors or short-term investors, yeah. But if you're an option trader, maybe you're at your happiest. If you're a long-term investor, maybe you shouldn't be bothered so much. But mixed signals for sure. That I give you. So what we're going to do today is we'll pick up best time to study macroeconomics. Yes, absolutely. Like I did an interview today in the morning. The interview was with a derivative trader, and it'll come on the Coffee Career show. And this guy was telling me that the macroeconomics is some sort of a current of the river, like some sort of a direction of the river. So generally, you'd find very few players who are able to swim against the current, right? So therefore, according to him, macroeconomics is super important. In equity world, we typically use the words tailwinds and headwinds, right? Yeah, tailwinds is basically something that will, the wind direction is from the back to the front, so it will propel you forwards. And then headwinds is basically wind coming from the other direction, so that will kind of create bottlenecks and hurdles. So it's very interesting to see in terms of how the markets will react to it. Okay, so if you're okay, and if everyone has settled down, then I think we are good to start. We'll get on with the company that we want to model. We will be finalizing the stock today as well. Yeah, Suraj, you know what? That's a good question. In terms of how to build scenarios, different themes playing out, and you want to assign different probabilities to each of the theme. For example, will Fed kind of act slowly, and will probably do somewhat similar to 70s, where the Fed was behind the curve the whole time. And if that's the case, the inflation will keep on piling up, right? If the Fed is behind the curve and the Fed kind of decides to act slowly and gradually, then the inflation pikes up, and then we'd be left with no choice but to kind of have a massive one-time increase and kind of shock the demand, right? That would be one way to look at this. If that happens, then we are in a long haul, and maybe the markets will remain bearish for a longer period of time. Alternatively, there are instances in the history, like I think again we were talking about that 1940s, where the central bank somehow managed to repair all the damage in a shorter period of time. So markets can swing, in either direction. You have to have your base case scenarios built in. For me, the base case scenario is the way I'm thinking about this is probably this pain continues for a year and a half, because the time, like the time of recession as a cycle has been reducing and reducing. So I'm guessing it continues for a year and a half, and provides fantastic opportunity of buying for long-term equity investors. And if that's the case, and if things reverse, then I think India will be one of the very attractive places in the world to park your money in, right? We're still one of the very few countries which are very few large economies which are providing 5-6% type of a GDP growth. So that kind of makes our markets very, very interesting proposition. Anyway, so with this I'm going to get started. Today we have to do the entire stack of ratio analysis. We have to do hard coding for one company on income statement, one for balance sheet. If there's anyone here who's not done previous sessions, it's okay, because today you'll be learning everything, right? Whatever we've covered in the past 2 sessions, we combine them and jam pack into this single session today. So it would be interesting day to learn. So we have to pick a company. I'm open to suggestions. Which company would you like to pick? If you would like to do, some sort of a manufacturing company, service sector, contract manufacturer, pharmaceutical company, I'm open to suggestion. We can pick up a variety of different companies. I was thinking more on the lines of doing, something like ITC. I think that would be an interesting financial statements to look at. Which balance sheet, by the way, we did in the last class? We did some balance sheet, right? I forgot which one. We did Tata Coffee. That's right. Thank you, Sandeep. Yeah. So I think let's do ITC now, because it's an easy business. Everyone understands, and we just want to learn. We just want to learn ratio analysis today. Tata Coffee, some disruptive business today. We would be doing an interesting business. I'll be disclosing the companies that I'm considering for financial modeling. Maybe in the last 20-30 minutes of the class, I'll take you through those companies. But right now, let's do the ITC financials. We'll start with the hard coding process. Here's what I want you to do. Go to annual report of ITC and download the annual report of 2022. I want all of you to download ITC annual report of 2022. And then open the consolidated financial statements there. All right, here's the annual report. Let me just clear the clutter on my PDF files here. Okay, here we go. Now, once we get into the financial statements, as you know, there would be standalone financials and then there will be consolidated financials, right? So we would try and work on the consolidated financial statements, which is on page number 233. Okay, so let's go to page 233. All right, here we go. So what we have here is the consolidated balance sheet as of 31st March 2022. And then we have a consolidated profit and loss account. Right? So we have a P&L and we have a balance sheet for a couple of years. We're going to take these. First, we're going to hard code them just for 1 year for 2022. So I want you to do the hard coding for the balance sheets and hard coding for the income statement. Income statement would be right below this, called as the consolidated statement of profit and loss. Then we will do some sort of a reorganization of the structure of income statement and balance sheet. And then we will be spending rest of the day doing some very interesting ratio analysis on them. Right. So with this background, let's start. I'm opening up an Excel file. We can do this work together. We'll start with income statement first. Consolidated income statement of ITC Limited. Column A, we typically put in your particulars. Column B is your support column. That's like a standard financial modeling, practice. So support or comments column. Then in column C, we generally go years. So right now we're directly going financial year 2122 actuals. Right, that's the financial year working with. So financial year ended 31st March 2022. So we typically call it as FY 21-22 actuals. And then the hard coding process starts. So we'll start with revenue from operations. Then we'll do other income. Then we have total income, which is coming in here. Right now, I'm just copy pasting it. Then we have variety of expenses. We'll be reformatting this. Cost of material consumed. If you have a Adobe software and if you're on a Windows machine, just hold the Alt button and select the area. You should be able to copy paste vertically as well. Okay, now ITC is a unique business that way because you would see that there's an item called excise duty, right? We'll have to work on the excise duty. We'll take employee benefit expenses, financial cost, depreciation and amortization expense, and other expenses. Just copy pasting it. Then we have total expenses, which is coming in here. Share of profit or loss of associates and joint ventures. Profit before exceptional items. In fact, there is no exceptional item, right? So I can skip that. So profit before tax. And then we have current taxes. We have deferred taxes. Then we have the net profit for the year. Okay, so that's your structure of the income statement. I'm going to start punching in the numbers. Revenue from operations, this is given in rupees and crores. So revenue from operations is this value. Just Control C, Control V. I hope you're able to do this along with me. Other income, here we go. Then the total income, which will be total of these two. I'm not worried about that so far. Cost of material consumed, purchases of stock in trade, changes in inventories and finished goods. That's a negative number, so be careful with that. Excise is 4536. Employee benefit 4890. Then we have finance cost 39. For such a large P&L, it's a negligible finance cost. So clearly looks like a very low debt or debt-free company here. Depreciation, other expenses. Okay. Then share of profit of joint ventures is 17. Then profit before tax is this number. Taxation 5306. Deferred tax 69.24. A simple Control C, Control V process here. That will give you your net profitability, which is here, and you're done. All right, so that's your profit and loss account for the current year of ITC Limited. Are you guys done? Now, then you can do you can also do is come on this cell. If you've done in the same format, which is C3, right below the heading, and then you can do Alt WFF on Windows machine, which will basically do the freeze panes for you. So it will make it easier for us to navigate through different columns. Okay. So I'm calling this tab as the income statement. And while you are onto it, I will start working on the balance sheet part as well. Same procedure. So this is your consolidated balance sheet of ITC Limited. In fact, I'll just copy paste the same format. So you have particulars, you have support or comments, and then you have FY 21-22. Okay, let's start doing copy pasting. Assets. Non-current assets. Property, plant, and equipment. capital work in progress. By the way, you can use tools like Textract and automate this whole process, but there's no harm in doing it once by yourself. It doesn't take a lot of time, 20-30 minutes. Goodwill, other intangible assets, intangible assets under development, ROU, right of assets, right of use assets, investments accounted for using the equity method. We'll discuss about them today. Then within financial assets, we will have investments. Then we have loans. And then we have others. Then we have deferred tax asset. We have income tax asset. And we have other non-current assets. All right, then we go to the current asset section. Try to do this with me. Even if you're slow, it's okay. Just keep on doing it. It's Alt Tab, Control C, Control V. You do this a few times, you get really good with it. Inventories, biological assets other than bearer plants. Okay, interesting. I don't know what that means. Financial assets. Within that, we have investments. ITC is a cash-rich company, so you want to kind of have a good sense of this. We have trade receivables. We have cash and cash equivalents. Why don't we take into account notes to financial statements? We have to, Arjun. But right now, we're just doing it on a basic level, but we do have to work on notes to accounts quite extensively. The moment we get into schedules, we will have to work with notes to accounts. These are loans. And then we have others within the financial assets. That's a lot of financial assets for ITC. And then we have other current assets. All right. Then we have the total assets coming in here. Let's go to equities and liabilities. Let's take equity. What we're doing now is, hardcore, old school, hard coding process. Equity share capital. As I told you earlier, you can, there are databases from where you can download this directly. There is also a lot of online tools available where this could be outsourced, but I still prefer to do it myself. It just gives me some time to be familiar with the numbers. I've reached the liability side of the balance sheet now. Non-current means long-term liabilities. Within that, we have financial liabilities, borrowings, lease liabilities, other financial liabilities. Provisioning, deferred tax, other non-current liabilities. Then we'll go to the current liability section. When I first started the whole financial modeling space, I used to find this work quite boring. And it used to take me a lot of time. But you do it for a while and then you kind of start enjoying it, because it allows you that time to get familiar with how the balance sheet has been prepared. You start observing small things, especially if you do it for a number of years, this hard coding process. Right now we're doing it just for 1 year, but if you do it for, let's say, something like 10 years, it's a couple of hours of work, but you learn a lot about how the company's accounting presentation has changed over time. That's a fairly large balance sheet here. I'm reaching towards the end. Okay, so first part is done. Now I need to punch in the numbers. I'll have to be a little careful while doing it. Property, plant, and equipment. Okay. Capital, work in progress. Investment property. Goodwill. So there is a goodwill here on the books. That's almost 780 crores. That's a large amount. Other intangibles, that's also quite sizable. 2,000 crores. I wonder what it is. Intangible assets under development, 27. Right of use goes on right here. Then investment value using equity method. You typically use this method when you own other company shares, but your ownership is typically less than 50%. So if you're somewhere between 20 to 50%, you use this method called equity method. So ITC must be owning shares in other companies. That's where this number is coming from. All right. Then financial investments, look at the value of investments ITC is sitting on. It's crazy, right? 12,000 crores of investment. They're running a mutual fund by themselves. Some would argue that this is the size of AUM some small asset management company will have. 12,000 crores of cash. That's crazy. Loans. All right. And then we have some other financial assets. Then we have deferred tax assets, about 63 crores. Income tax assets, 42. Other non-current assets. Sure. Inventory is about 10,000 crores. That's also quite sizable. Biological assets other than bearer plants. Financial assets. Look at short-term investments. So long-term and short-term investment combined, it's about 24,000 crores worth of cash sitting on the books. It's a cash generating machine, this company. Trade receivables. Cash and cash equivalents, another 270 crores. Other bank balances, interesting. There's money everywhere. 4,300 crores here. Then they've given loans to someone worth 7 crores. I hope not to directors. Others is here. Other current assets, another 1,300 crores. Okay, I'm going to run a sum on this. Total that I'm getting is 77,259. I wonder if that's correct. Let's go and check. Yeah, 77,259. All right, so asset side is done. Let's go to equity. With equity share capital. If you guys are done, you can give me a done on the chat box. If you are midway, give me percentage progress. Other equity, non-controlling interest, also called as the minority interest. Let's go to borrowings. Borrowings, 4 crores, that's a joke. Lease liabilities, 193 crores. Other financial liabilities, 144 crores. Provisioning, 221 crores. Deferred tax liability, 1673. Other non-current liability, 36.43. Okay, then we have financial liability. There's a short-term borrowing of less than a crore here. Accounts payable or trade payable. Okay. Broken down into two parts. Lease liability, another 50 crores here. Other financial liability, 1812. Other current liabilities here. Short-term provisioning, 79.55. And current tax liability is 687. And we're done. So let me run a sum on this again. Okay, this is the total here. So far our balance sheet seems to be tallying. So we have total of assets and total of equity and liabilities. Don't worry, I'll be explaining every item on balance sheet and income statement to you. Running a check formula here. A check formula is simply whether assets are equal to liabilities. Yes, they are. Okay, here we go. Where have you reached? What is your progress? %, 15%, 20%. What's the progress? Saksham, keep all your questions on hold. Keep on posting your queries. I'll try and answer them once everyone is done with hard coding. Are you done? Okay. I've just shared a link with you on the chat box. Can you confirm if you can download my version of the file there? Just confirm if you're able to download the file from there. Right. So I'm doing this so that we can work on the same file. So it'll be easier for both of us. Can you guys test if the link is working? Are you able to download the file? Okay, good. All right. So please download the file. We can do some interesting work on it thereafter. Everyone, if you build it yourself, that's great. If you haven't, then just download the file, right? So that we kind of maintain consistency in terms of how we're doing it. Okay. Nice. So now all of you be with me. All right. Here's what we're going to do. Every time you work with income statement and on balance sheets, you realize that companies will, take some liberty with how they want to create their own format. Okay. But when you build your income statement, you want to build in such a way that it will be easier for you to model the numbers going forward. So I did show you this in the first class, and I'm going to show you this again. What I'm going to do now is to create a few rows right below this particular income statement. Okay, so I'm just adding a few rows here. All right. So I'm just adding a few rows, and I'm going to rewrite the whole income statement again. Now, I want you guys to listen to me carefully. Don't do anything. Be with me. Watch how I'm doing this. Then you do it yourself. Right? So the first thing that I'm going to do is I'm going to write down a simple sales number here. Okay. Do I have the sales number? Yes. It's 6520. Parallelly, what I'll start doing to ensure that I'm not, missing on picking up any number correctly, I'll start also color coding them so that I know I have dealt with these numbers in my revised format. So I will have sales. Once I've had sales, then immediately I will have cost of goods sold. Cost of goods sold. Cost of goods sold. Now, COGS. How do you do your cost of goods sold? Typically, for a manufacturing firm, you would see these three items. Okay, if you look at some US financials, a lot of time cost of sales is directly given. But in India, we generally provide these three items. Akash, keep it on hold. We'll do it step by step. Okay. So we have cost of material, we have purchases of stock in trade, and then we have changes in finished goods. When you take a total of these three items, including this one being negative, changes in inventory, then you get your COGS. We'll do the exercise adjustment. Take it easy right now. So first you take a sum of these three items, 1, 2, and 3, and see what that sum is going to be. It's 26,385. This 26,385 is your cost of goods sold here. All right. So what you're going to do is you're going to copy this, and then you're going to do absolute value paste. So in Excel, the shortcut you can use is Alt ESV in sequence. That's the formula I remember. This is the old Microsoft Excel 2010 formula. Copy and then Alt ESV sequentially, it will paste the value for you. Okay, so this is my cost of goods sold. So again, one more time, how did I take cost of goods sold? I took total of these three items. Which three items? Cost of material consumed, purchases of stock in trade, changes in inventory and finished goods. The total of these three items came out to be 26,385. So I did Control C. On the MacBook, the shortcut that I use is Option Command V. Option Command V, and then I pasted value. On Windows machine, you can do a Alt ESV. First press Alt, then press E, then press S, then press V. It will do an absolute value paste. If you just do Control C, Control V, then it will, pick up some wrong number like this, because it is trying to pick up some sort of a formula, right? So it will not make sense. So you have to do an absolute paste here. Absolute paste means you want to paste the value, not the formula. All right. So these three items are done. Then the next item is excise duty. Okay. Now, what is an excise duty? Excise duty is tax on manufacturing. Okay. For example, if an excise duty, you would wonder, Utkarsh, how come we have excise in India? Don't we have GST now? And yes, we do have GST. But there are certain items on which we still charge excise duty. Okay. And one of those items is tobacco products. So ITC is in the cigarettes manufacturing business. So they still have to pay taxes. So the way this works is, imagine I want to sell my product at 10 rupees, but on behalf of government, I will collect 2 rupees and my sales will become 12. Okay. But out of the sales of 12, 10 is my net revenue. 10 is my net revenue, and 2 I'm just collecting on behalf of the government in the form of excise duty. Okay. So therefore, what you want to do is you want to reduce that 4536, which has been shown as an expense, but truly it's not an expense. When you made sales of 65,204, out of this 4,500 were just collected on behalf of the government. So you want to have a net number. And therefore, here's what I'm going to do. Now, please observe carefully. I'm going to do 65,204. Okay, let me zoom this a little bit further for you. Just a minute. Yeah, okay. So I'm going to do 65,204 minus 4536. Okay. And this number that I get now, 6668, I'm going to copy this. So Control C and do an absolute paste here in terms of sales. So I'm going to do Alt ESV or Option Command and V together, and then paste value and hit OK. And then I'm going to come here and I'm going to write down sales net of excise duty. Right. So we'll have the net revenue, not the gross revenue. So that's going to be 60,668 and cost of goods sold will be 26,385. I hope you guys are comfortable with this process. Okay, so we've dealt with excise duties as well. Now, once you have deducted cost of goods sold from your sales, then you get a number which we call as the gross profit. Okay, GP. And what would be your gross profit here? It will be the delta of the two. So this number minus this number. So your gross profit is 34,283. Okay, so you do this. I'll wait for you. Once you're done, let me know. And then we will do the subsequent steps together. So we'll kind of work in partnership today. So you guys try and finish this piece. And whenever you're done, give me your done on the chat box. Apart from excise, what else is adjusted for sales? Generally, all the indirect taxes, Aristus, indirect taxes means taxes which are, charged on sale of goods like VAT, GST, excise duty. These are the items we adjust. And then it also depends on, situation. Right? But generally, these are the items that you need to be aware of, especially excise duty and GSTs and VAT. These are the taxes. Because then if you include them, your revenue will look unnecessarily inflated. But all that you're doing is just collecting on behalf of the government. So you want to remove them from your revenue. Okay. Please let me know once you are done. Do you build PPE schedule alone in your model? As in, I don't know, Jerry, what that question is supposed to mean. Like, do I take help of others or do I build it by myself? Is what you're asking? I want to see how you do PPE schedule and not use a percentage of sales approach. Okay. I might use percentage of sales approach if it's a very fungible capex setup. Like if the situation demands using percentage of sales, but at times I would build a capex. Most of the time when I build my PPE schedules, I build them based on management guidance. Yeah. So my process is basically I don't forecast. I mean, generally, I wouldn't forecast revenues first and then go to PP schedule for manufacturing businesses. It's generally the other way around, where I will forecast the PP schedule first and then go to revenues. Generally, my starting point is what guidance has the management given, right? So the recent model that we built on Shelley Engineering, it's a plastic manufacturing company. We took the input from the management in terms of what guidance they gave us. Like they gave specific numbers over the period of 18 months, 20 months, and then we built. Yeah, there are a couple of other approaches, Jerry. I mean, percentage of sales works in some cases, but typically, it is always conditional. I think the best way to do it in practice, not theoretical, is talk to the management and get a sense of what are their capex plans, and then reverse engineer everything else. Okay, guys, are you guys done? Is everyone done? All right then, so I'm going to do the subsequent parts now. So we've got the gross profit. Then we will bring in other expenses. So here I'm going to bring in employee benefit expense. So employee benefit expense, what's that number? 4890. So again, you guys just wait and watch, observe carefully. Employee benefit, what does employee benefit expense mean, by the way? Employee benefit expense is what? So employee benefit expense 4890. Then other expenses, which will be 8734. That's quite sizable here. 8734. Okay, depreciation, finance cost we will deal with separately. Share of profit of joint ventures will deal at a later stage. All right. So you deduct these two expenses. When we say employee benefit, it means salaries plus provisioning for pensions. Provisioning means payments that I have to make in the future. Okay, so employee benefit is primarily your current salaries, but also a little bit of provisioning for the future. So in a simple language, these are salary expense. That's it, right? And what is other expense? All type of expense that the company clubs into one category. So if you want to investigate what other expenses are, you can always go to this particular notes to accounts, right? So other expenses in note, sorry, my screen should be visible to you now. Okay, it should be visible to you now. So other expense here, if you go to note 26, you will find all the information on other expense, generally a very large schedule. Okay, but for the timing, we'll just work on this. So we have gross profit. Then you deduct these two expenses. What do you get next? From gross profit, you deduct these two items. What do you get? You get earnings before interest, taxes, depreciation, and amortization. Earning before interest, taxes, depreciation, and amortization. Okay. Do we call this number something? Yes, of course we do. We call this number as EBITDA. This number is referred to as EBITDA number. Okay, it's not EBIT just yet, it is EBITDA. Earning before interest, taxes, depreciation, and amortization. All right. EBITDA is also referred to as cash operating profit. So here we're going to do 34,283 minus employee benefit minus other expenses. So your EBITDA number has come out to be 20658. All right. Shaman is asking, is the excise portion considered to be a risk? In the future, government can change the excise rates, and will that be a risk for ITC? Yes. So one of the big risks for businesses like ITC is obviously the regulatory risk, right? There is that because tobacco is traditionally considered as a sin industry, so governments will charge taxes called the sin taxes. I don't know if you've heard of this term before, but taxes on alcohol, taxes on tobacco products, taxes on gambling. So one of the risks that ITC faces is that governments will increase the risk. Government will increase the taxes, and the cost of the product in the market will go up. And then as an investor, one of the calls that you need to take is, will consume less of it when the prices go up. I mean, prices in developed world, for tobacco products are about 5 times higher than the prices that we have in Indian markets, right? So if the prices go up by 10, 15, 20%, will that have a significant impact on consumption of the product? That's something that needs to be evaluated. In fact, that's one of the reasons why the stock has been kind of underperforming over the period of last 5 to 7 years. Okay, so this is EBITDA. What do you do next? Next item that you do is you deduct the depreciation and amortization expense. So depreciation and amortization expense of 1732. So once you deduct depreciation and amortization, then the number that you get is called earnings before interest and taxes, which is EBIT. This is your operating profit. Okay, so you've reached your operating profit levels here with the EBIT. Now, EBIT is kind of a critical number, and when we learn modeling and get into nitty-gritties, you would understand how critical this number is. But for the timing, we just do the maths, which is 20658 minus 1732. So your EBIT number here is 18,926. That's a good number, right? That's 18,000 crores of profitability. 1 crore is, by the way, 10 million. So you can multiply this number with 10 to get a sense of how many millions we have here. This is in rupees, of course. Okay. Now, what do you do next? So the next thing that you do is you do finance cost. Okay. Finance cost is nothing but your interest expense, which is 39.36. And notice how we'll take this other income, and this other income, we will bring it here. Okay. So in the original presentation, this other income was provided as a part of total income right at the top. But the thing is, the name other income itself suggests that it's not generated through core business operations. So when I want to calculate core business ratios, I don't want those ratios to be affected by other income, right? And therefore, the other income number, we kind of push it towards the end here, right after EBIT. And then we get earning before taxes. Okay, earning before taxes and before the, okay, you know what, we'll just for the timing call it as earning before taxes. That's it. So we have earning before taxes here. And earning before taxes. Now observe my formula here carefully, please, because one of them is an income item. So we've got to be careful here. So what we're going to do is, I hope all of you are with me on this. Look at formula here, is equal to EBIT minus finance cost plus other income. EBIT minus finance cost plus other income, that will give you earning before taxes, EBT. So that's your earning before taxes here. Then we will take, so we'll call this earning before taxes before the share of associates. Okay, because that's one item that needs to deal with. So now we'll take the share of associates here. So share of profit and loss of associates in joint venture. What does it mean? It means, you have made investment in some companies, or you've entered into joint venture where your ownership is typically less than 50%. Why 50%? Because after 50%, you get the control. So generally we say when your ownership is between 20 to 50%, into some other companies, that's when these methods kick in. Share of profit and loss of associates and joint venture. And that's a small amount, just 17 crores. And once I add this, then I get my true earning before taxes. So this is my earning before taxes, EBT. So I'm going to take earning before taxes and add this up. So this plus this, there you go. I have my EBT ready. Once I have my EBT ready, then we will say tax expenses, tax expenses. Now, when you want to take tax expenses in the accounting world, you kind of deal with both of these numbers. Okay, which two numbers? You deal with the current tax as well as the deferred tax. The total of these is typically your income tax expense. So I'm going to take total of these two items here. Okay, so let's take a total of these two items, current tax as well as deferred tax. Look, notice that deferred tax is a negative number. So 5237, copy this and then do an absolute paste, Alt ESV. Or if you're on a MacBook, Option plus Command plus V. All right, and once you've done this, once you've taken care of your tax expense, then everything is done. And then we will have earnings after taxes. Earnings after taxes, called as the EAT. And let's see how much is the total here. This number minus this number, I'm getting 15,503. Okay, let's check that with the annual report. 15,503.13. I hope you can see this, 15,503.13. So we've done an income statement. All right. We through with the preparation of the income statement. All right, so you guys do this and let me know when you're done. In the meanwhile, I'll answer some of the queries on the chat box. Sudhankar says that's the risk for any business. Yes, Sudhankar, that's a risk for any business, but especially in case of alcohol companies and tobacco companies, that's slightly inflated risk, because these companies are easy targets for politicians. When a politician, when politicians or the government will increase tax rates, you and I will not be happy. But if they increase tax rates on tobacco companies, alcohol companies, they get more revenue, but at the same time, they look like they're doing some sort of a welfare economics. So because tobacco companies, alcohol companies are easy targets, that's kind of a higher risk for companies like these. Shamin, Shamin is asking, I've signed up, I've paid for Zoom classes. Can I unmute and ask? Of course, Shamin. So next session onwards, we move to the Zoom sessions. This is the last session on YouTube today. So you can of course talk, and there will be a lot of talking. In fact, I prefer it this way. I wish there was an option on YouTube to do that, but there isn't. But yes, I mean the whole sessions will be conversational, because I think that was, I'll also get to learn from you guys. I just came across your videos. I'm going to watch it. Sure. Thank you very much, Arshit. In our model, is it worth putting a negative sign or bracket on the lines which are subtracted? I generally don't do that, because then you need to be really careful with what formulas you're using. So I generally don't use negative signs in the model. But that's one way to do it. And I've seen a lot of analysts do that as well. Soham is asking, what is the EBITDA if EBIT is operating profit? Used to think EBITDA is operating profit. Yeah, Soham, generally EBITDA is called cash operating profit. Okay, so the difference between the two is this depreciation is a non-cash expense, right? You don't really pay any cash for it. So if you take EBIT and if you add back the depreciation, you get EBITDA. I mean, the other way around, right? If I take 18,000 and add this 1,700 to it, I'll get this 20,000. So EBITDA is called as the cash operating profit. What have I done with the deferred taxes? Yeah, sure. So what I did with deferred taxes is I just took a total of current tax and deferred tax. So taking a total technically means deducting it, right? In a way. So we have 5306 and minus 69. That gave us 5237. And I just took that 5237 and put that here, but an absolute number. Are you going to model an FMCG company in this batch? No, Avinash. I'm kind of tired of modeling FMCG. I've modeled too many of them. We would be modeling a SaaS company, a software as a service company. But I'll disclose the name towards the end of the class today. Some of you might have already guessed because that company, I've been talking about it for a while. But yes, we'll be modeling a newly listed company. So we'll have to work with prospectors quite a bit, but it'll be a fun learning exercise. Okay, are you guys done? Please let me know once you're done on the chat box. You mentioned that you do these classes once in a while. Is there a confirmed upcoming cohort after this one in October, November timeframe? No, Shamin, there is no definite timeline in terms of when I'll be doing it next. This batch itself, I think, will easily go to about 3 to 4 months. So we are looking at, July, August, September, somewhere around October, this gets over. I'm not really sure if I'll do one right after that. If the share is from 50% and reported in the equity section, will there be a tax effect? It is this taxation laws are different and accounting rules are different. So what we're doing is we're taking profit of our associate. These companies are called associates. We're taking their profits and we are, if they're making profit of 100, and if I own 30% of them, then 30 worth of profit I'm showing in my books, but I don't pay taxes on them because you don't pay taxes based on this income statement. You pay taxes as per the taxation laws, and you have to kind of prepare a separate income statement as per the taxation rules. So no, you don't pay taxes. The company which made profit, they will be the ones paying taxes. But again, if you just think that taxation laws are different and accounting rules are different, a lot of this thinking becomes easier. A lot of people think that I'm going to pay taxes on this 20,740. No. You're not going to pay taxes on 2740. You're going to pay taxes on profit calculated as per the taxation laws. Regards from Ecuador. Oh, hi, Ricardo. Now, nice to have you. What time is it there right now? In other expenses, are they considering advertising expenses? Yes, most probably yes. Because if you would see other expenses, a very large number. So if you want to kind of dig deeper, I'll show you. It's easy. What you need to do is other expenses is note number 26, right? So we need to go to note number 26 and find out other expenses. So okay, I have to scroll down quite a bit for this. I've reached note number 17, 22, 22, 23. Okay, 23 is other income actually. Employee benefit 25. Okay, here we go. These are your other expenses. Look at this. There's power and fuel, consumption of stores, contract processing, rent, rates, insurance, repairs, maintenance, outward freight, warehousing, advertising, market research, design, hotel reservation, retail, brokerage, commission, doubtful debt, bank and credit card, information, traveling, training, legal, consultancy, postage, printing, blah, 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 blah. Out of this 8,000, if I look at the biggest amounts, so we have 1,600 crores being spent on outward freight, like freight is just transportation charges, right? Then close to about 1,000 crores is being spent on advertisement and sales promotion. Then 480 crores is being spent on consultancy and professional fees. I wonder what they do here. And look at this. It's crazy. ITC spends 1,100 crores on miscellaneous expenses. It's I really hate companies which use this head, because putting 1,000 crores under this uh, basically means we are not going to tell you where we spend that money, right? So, and 1,000 crores, 1,100 crores, that's a large amount. So 1,100 crores under miscellaneous expenses is kind of outrightly stupid. But yeah, that's how you read other expenses schedule. Okay, tell me your progress. Where have you reached? Are you done with the income statement? Guys, what's the progress? Give me an update. Do you need time? Are you done? What's happening? Okay. All right, cool. So let's take a small break. We'll keep on taking breaks today so that there's no fatigue and we learn in a nice, beautiful, structured way. So we'll have a break for, I don't know, 15 minutes now. And then after the break, we'll resume. We'll do balance sheets and then we'll get on with ratio calculations. We'll be doing some very interesting stuff today. Right. So I'm putting on a 15 minutes timer for us. After the break, we're going to work on balance sheets. And then we're going to start working on ratio analysis. The session will continue till about, let's say, another 60 to 70 minutes. All right, I'm ready when you are. Yeah, next session onwards, we're shifting to the Zoom. And we'll start with the actual modeling process. All right, so income statement is done. Let's work on the balance sheet a little bit. PP, capital work in progress, investment property, goodwill, other intangible under development. Everything remains as it is. Nothing needs to be changed. Financial assets, we have. Sure, Inder. Uh, I will take 20 minutes, 20 minutes maybe. I can answer all the queries. Investments, loans, others, deferred tax asset, income tax asset, and non-current assets. Then we have two items on inventory. Then we have a ton of financial assets. That's your total assets. No reworking required on balance sheet asset side. Liability side, we have total of these three items, which is your equity. Then we have borrowings, lease, other non-current, then we have current financial liabilities. This is also a subheading actually. We have short-term borrowings, then we have trade payables. Now, trade payables, I believe this classification is unnecessary, right? So what I'm simply going to do is observe what I'm doing with this. I'm going to take a total of these two items. Which two? Outstanding dues of micro and small enterprises and outstanding dues of creditors other than micro and small enterprises. And then copy this and put this in front of trade payables, but an absolute value, right? So Alt E S V. And then delete these two line items because we don't need them. So all that I've done is taken total of these two and put that in trade payables. And then I'm going to delete these two. So you don't really have any value of these items from a modeling perspective. Lease liabilities, other financial, other current liabilities, and everything seems all right. Okay, so your income statement and your balance sheet is ready. Give me a minute. I'll share this file with you so you can work with this file. All right. So that way, all of us are working together at any point of time. Allow me a minute. I'm uploading this on a Google Drive now. Okay, I've uploaded the file on the same link. So you should be able to access that now. I also put it on your chat box. Okay. Can you try the link that I've shared and download the latest version of the file, please? Can you confirm if you've been able to download the latest files? Done. Fantastic. So here's what we're going to do now. We'll first work on income statement and do a vertical analysis. Okay, all of you work with the latest version of the file. So I'm going to say vertical analysis here, right next to it. I did show you how to do this in one of the earlier classes. I'm going to show you again. Okay, very easy, simple analysis. Everyone, please observe my screen carefully. Okay, you get this thing right. It's going to make your life very, very easy. So is equal to, okay, observe the formula carefully, please. I hope you're looking at my screen. Is equal to, let me zoom this a little bit for you. Yeah, is equal to the revenue, which is 60,668, which is in C3, divided by the revenue again. Okay, so it's a simple C3 by C3 formula. Then when I copy paste this, I want my denominator to be coming in from row number 3 always. Okay, so because I want my denominator to be coming in from row number 3, I'm putting in a $sign in front of 3. Okay, so the denominator will always become sales, but numerator will keep on changing. What's the logic for numerator? Any cell which is on the left, right? C3. C3 means the way Excel reads the logic is cell on the left, right? And I'm going to hit enter and then copy paste the formula here. And then do some formatting, Control Shift percentage, and maybe have 2 decimals on display. That's it. So your vertical analysis is completely ready in one single go. Let me do this one more time. I'll show you how to do this. I'm deleting what I have. Okay, observe the formula is equal to C3 divided by C3, and then put in a $sign in front of 3. And then copy this. Okay, and then you can copy paste the formula. You can also do Control V. It's just that I want to maintain the formatting that I've done. So instead of simply doing Control V, I'll say Control Copy, select this entire region, and then Alt ES F, enter. So when you do Alt ESF, it will copy paste the formulas. So here you go. That's your vertical analysis. Now this thing is extremely powerful. Okay, because this gives you insight on what's happening in the income statement. And observe carefully. If my revenue is 100, then my manufacturing cost is about 44. Okay, the way you want to read this is manufacturing cost is 44. So whatever products I'm selling at 100 after excise, after GST, right? Remember, we made those adjustments. So after removing excise, after removing GST, GST is goods and service taxes. If I make a revenue of 100, my manufacturing cost is 44, and therefore my profit on manufacturing is 56. All right. Now, once I have this 56 profit, which is called the gross profit, profit on manufacturing, then this profit needs to take care of other costs. So what are the other costs? Employee benefit, 8% of revenue. So I'm spending about 8% of revenue on my employees. That looks like a standard thing for most of the manufacturing business. On other expenses, which if you remember included freight, outwards, it included advertisement and other costs. I'm spending about 14%. EBITDA, which is cash operating profit. I told you EBITDA is also an operating profit, but generally called as a cash operating profit. That's 34%. Depreciation is 2% of revenue. That's how I'm getting operating profit level of 31%. This is called operating profit margin. Then finance cost negligible. Other income is contributing 3% to the revenue. So therefore, my EBT before share of associates is 34. This is also 0.03, no big deal. My earning before tax is 34. My tax expense is 8. And therefore, earning after taxes here is 25.55%, which means my net profit margin is 25.55%. Is that a good margin? Yes, it's a fantastic margin. Right? How many businesses you would come across which will exhibit such massive profitability on such a large base? So ITC did revenue of 34,000 crores, and on that they were able to generate, they did revenue of 60,000 crores, and on that they were able to generate net profitability of 15,503 crores. So that is the benefit of doing this type of a vertical analysis on the income statement. Within fraction of a second, it gives you fantastic insights. Are you guys okay with this? Have you been able to do it yourself? Okay. Let's go to the balance sheet now, and let's repeat the same drill. So now we'll do vertical analysis on balance sheet. The formula works the same way. All right. So again, you're going to observe. I hope you guys are looking at the screen carefully in terms of how we're building the vertical analysis here. So please look at this. 20,207, which is in C5 in the file that I've built, divided by 20,207 divided by, take the total assets 77259, which happens to be in cell number C31. Now again, when I copy paste this vertically, I want the numerator to keep on changing, but I want my denominator to be constant, which is the total of assets and total of liabilities. So with that logic, I need to freeze the row 31. So we'll say C5 divided by C31, but we'll put in a dollar sign in front of 31, so that the row number 31 is frozen. All right. And then we have these values. I'm going to copy paste this and then copy paste that, just, copy paste the formulas here. That's okay. In fact, I'll format this before I copy paste. We'll have 2 decimals in percentage. Okay. And then copy it here, copy it at all the right places. This would obviously be 100%. Then again, I can copy paste the same formula, because total of equities and liabilities will always be same as total of assets. So copy here. Then we will copy this here. And again, this total will be 100%. Okay, let me know once you're done. So our vertical analysis of income statement and balance sheet is ready. Let's have a quick glance over the balance sheet number. Out of the total assets, about 26% is property plant, 4% in work in progress. So that means, about 30% of the balance sheet is made of this number. Then we have investment property, negligible, goodwill, though absolute number is very large, for relative terms, it's very small. Other intangible is about 2.61. No number is significant here. Look at this, 15% of the financial assets is made in investments, right? So 15% is investments. Then we have 14% in inventories. So that's a sizable chunk being parked in inventories, right? These are the important numbers for us to focus whenever we are modeling this. Of course, we are not going to model this company, but it gives you insight on which are the key numbers you want to focus on. Then about 15% is again investment. So if you'd see if you'd see where is the other investment, long-term investment of 15.93, so about 16%, and short-term investment 16%. 32% of the balance sheet is actually investments. That tells you that this company is sitting on massive amount of cash, and probably they don't know what to do, because it's not an investment company, right? It's not an investment company, but about 32% of their balance sheet is made of investments. That's too much of cash to have. On top of it, they have another 6% in bank balances. So that's 32 plus 6, 38% sitting on bank balances. That's way too much. What else do we have? On the liability side, the total equity is about 79. So let's say about 80% is total equity. So clearly not enough, no liabilities or external liabilities on the book. Trade payables is about 5, and that's it. And then we have other current liabilities of 6.62. And there you go. Done. This is your vertical analysis of the ITC financial statements. So the beauty of doing vertical analysis, and I recommend, always this is a starting point when you're analyzing financial statements, because, single formula, but it gives you fantastic insight, especially if you're doing this for multiple years. If you had 5 years of hardcore data, and if you were to do vertical analysis, it would not only give us understanding of which items are important, but also an understanding of how the items are changing over a period of time, right? And that gives you some sort of an insight in the modeling process. Okay, let me answer a few questions on the chat box. You guys can feel free to post your queries. I'll try and answer them. And if you've understood this, then just give me, I'm okay, I've understood, I understand, or whatever you want to communicate. Can you make a DCF model after you finish from the statements? Fatima, not today. Because in order to build DCF model, Fatima, you need to forecast the numbers, right? So right now we're just working with historical numbers, that too for 1 year. We're not forecasting them. The company that I would be modeling in this course is a software company, or software as a service company. It will take about 10 sessions to build a forecast of the numbers, and then reach a DCF and then do a valuation. So can't do it today. What's the difference between investment under financial assets and investment accounting for equity method? That's a good question, Saksham. Let me answer that for you here. So here's how you want to think of it, Saksham. So ITC is investing into other companies. ITC is investing into other companies, right? So When one company invests into other companies, we call this as intercorporate investments. Intercorporate investments. Josefa, if you're on a Windows machine, you can try Alt H0. If I remember the shortcut well, press Alt, then press H, press 0. If that doesn't work, try Alt H and 9. One of the two will increase the decimals, or you can just go and do it manually. Okay. Now, let's say these investments, we typically classify them into three categories depending on what's your ownership. Okay. Generally, ownership is a benchmark. So if you own less than 20% of the ownership, or if you own between 20% to 50% of the ownership, or if you own 50% and above. If you own 50% and above. Okay. So if you own less than 20% of the ownership, then typically these are classified as the financial investments. So, ITC owning, let's say, 1% stake in, I don't know, some manufacturing company. We'll call that as financial investment. So all the financial investments that you see here on the balance sheet, right? Where are those? Here. These investments or these investments here, these are short-term investments, right? So these are your financial investments. But if your ownership is above 20%, then you can start influencing that company a little bit. If your ownership is more than 20%, you can influence that company to some extent, right? So then this is referred to as investment in associates. And then the accounting for this is different. Okay, so investment for associates or equity in, these are called equity investments. Now, even this is equity, but this is called as the equity method of accounting. Equity method of accounting. So it's different than how you typically treat financial statements. And if you own 50% above, then you have control, right? Then this company becomes your subsidiary, and then the accounting method differs. So depending on what percentage of ownership I have, whether I have less than 20 or I have 20 to 50 or 50 and above, my accounting treatment for them is going to change. So hopefully that answers your question. Can you make a modeling of a US company? Jerry, I've modeled Starbucks in the past. I've modeled Match Group. Some of these videos are available on FinTree Learning Management System. This class, we're modeling a company which gets 70 to 80% of its revenue from the US market, but they chose to list themselves in India. But we'll be studying US markets quite in depth US markets in our industry quite in depth in this particular class, but no, we're not modeling a US company this time around. Shortcut worked. Thank you. Fantastic. Josefa, good. Low goodwill and intangible asset means growth is not based on mergers and acquisition. Yeah, that's one way of saying it. Or other way of saying it is that whatever mergers they did not pay a very high valuation. Either ways, the goodwill number on a relative basis is low. Absolute number, it looks very large. It's massive, right? When you look at 779 crore rupees, that's a lot of amount. But on a relative basis, in percentage basis, it's just 1% of the balance sheet. So that gives you some sort of a comfort. How can I tell how much debt a company can take based on their balance sheet? Good question, Brian. So typically, you work with certain ratios, and it works from industry. But let's say something like a debt to EBITDA level. Okay, so you don't want that level generally. Generally you don't want that level increasing 3 times. So if I had to guess for a company like ITC, if I had to do a debt to EBITDA, their EBITDA levels are, look at this, EBITDA levels are about 20,000 crores ballpark. So I would say maximum debt they can afford to take is 60,000 crores, right? If I have to keep a debt to EBITDA level of three times. If I want to be more conservative and if I want to keep debt to EBITDA level of 2 times, then I would say, then the maximum debt is 40,000. Or You can come to balance sheet and you can say, what's my total equity size? So your total equity size is roughly about 62,000 crores. And you would say that I can take debt to equity ratio of 50%, right? That's what I should be doing. So you take half of this, then your debt level, permissible debt level becomes 30,000. So how much a company debt can be taken is a function of industry and what are the ratios with which the bankers and the company will be comfortable. Debt to EBITDA, debt to equity, interest coverage ratio, debt service coverage ratio. So there's a modeling process to it. Yeah. In fact, I'm currently working on a deal uh, or a transaction. We'll be doing somewhat similar calculations. How is this classes going to be? Josefa, first 3 classes we did on YouTube, then we would be migrating to Zoom. Just go on FinTree website, you'll find all the information there. What is other equity? Other equity is nothing but typically your reserves, and retained earnings. Reserves and retained earnings. So, a slightly oversimplified explanation will be all the profits that the company has made over time, which they have reinvested. Typically, we classify them as reserves and retained earnings. So all the profits which have been reinvested come in here. Sure, Vandit. Of course, I remember you. Okay. Are you guys done with vertical analysis and income statement? So once you've reached with me, then we're going to start doing some sort of ratio calculations. Please confirm once you've reached so that we can do ratio calculations. Okay. All right. Let's start. Let's start doing some interesting ratio calculations here. So I'm creating a new tab. I'm calling this as ratio calculations or just ratios. This is going to be fun. If there's any CFA student here, this is also part of your syllabus. So you're kind of learning a lot out of this process, even for your exams, CF level 1, level 2. A lot of these ratios will be repeated. And these are good ratios to know, right? I mean, you'd use of them every now and then. So I'm going to say ratio analysis of ITC Limited, and then just copy paste this format as it is. Now, the first set of ratios that we will start calculating will be called the profitability ratios. Profitability ratios. Now, there are multiple profitability ratios. The first one is gross profit margin. Now, can anyone tell me on the chat box what's the formula of the gross profit margins? Formula of gross profit margin. Correct. Simple, straightforward, gross profit by revenue. So I'm going to also show you the process of linking here. Okay. So I want you to observe carefully, see how I'm doing this. Is equal to, observe how the formula is written, is equal to, go to income statement, select gross profit. Okay. Select gross profit divided by sales. Simple. Gross profit divided by sales, enter, and then control shift percentage together to change the formatting. Control shift percentage. If you need, if you need central format or central alignment, right? For example, if your number looks like this and you want it to be centrally aligned, you can use a shortcut Alt H AC, I guess. Try this, maybe it will work. I'm not using a Windows right now, so I can't test it, but I think this is a shortcut Alt H AC. That should kind of do central formatting for you. If you want to convert that number to percentage format, you need to press Control Shift together, and then you need to press percentage. If you want to increase the decimals, it will be Alt H and 0. These are some of the shortcuts you can use. Right? These are simple formatting shortcuts. One cool thing with Excel, if you're using it on a Windows machine, is you have this magic button of Alt. Alt makes your life really, really easy. Please do watch my basic Excel videos. I've explained usage of all the shortcuts there. But okay, here we go. Gross profit margin of 56.5. Next formula is cash operating profit margin. Cash operating profit margin, which is nothing but EBITDA by sales. EBITDA divided by sales. This was gross profit divided by sales. Okay, so let's do this. Is equal to, go to income statement, select your EBITDA levels, divide that with the sales level, and that number is coming out to be 34%. All right, I hope we are together on this. Then next one is operating profit margin. Operating profit margin would be EBIT divided by sales. So is equal to, go to income statement, choose your EBIT divided by sales. Now, by the way, when you build vertical income statement, all of these ratios are already covered for you. Right? Vertical income statement, these ratios were already kind of taken care of. Okay. So operating profit margin is also done. Then we do something called as a pre-tax margin. Pre-tax margin is EBT divided by sales. Earning before taxes divided by sales. So is equal to EBT divided by sales. EBT divided by sales, 34.2%. And then you will have the net profit margin. Net profit margin, again, a useful metric. Earning after taxes divided by sales. So that will be equal to net profit margin divided by sales here. We already have this number from vertical analysis, 25. In fact, all these numbers we had already worked through in the vertical analysis tab. All right. Now, next one is not in that vertical analysis tab, called effective tax rate. Who will tell me how we do effective tax rate calculations? Effective tax rates. Effective tax rate is how much tax expense I have, how much tax I'm paying as a ratio to what was my earning before taxes. How much tax expense I had as a ratio to earning before taxes. The simple logic is, my total profit before taxes was 100 and I paid tax of 20. So my effective tax rate becomes 20%. Okay, so please observe how I'm writing the formula. Everyone, look at this carefully. Is equal to income statement. Income statement, we will take tax expenses here divided by earning before taxes. Tax expenses divided by earning before taxes. Okay, so my earning before tax was 20,000, tax expense was 5,000. So that number is coming out to be 25.3%. Now, this number we generally compare with something called as a statutory tax rate. Statutory means what government of India says, right? ITC operates in India. So what government of India says. And effective tax rate is how much company is actually paying. The difference between the two arises because of some complications with the taxation laws, international business, foreign subsidiaries, consolidation, and all those technical things that come into play. So this is an important metric, and you need to be aware of this. Effective tax rate is tax expense divided by EBT. All right. Next number is return on equity. Who will tell me how we calculate ROE? Very important metric. Return on equity. This is calculated as net profit divided by, generally we use average equity, but here we have only 1 year of data. So I'm going to use closing equity. Okay. How much money owners of business have invested? How much money owners of business have invested? And on that investment, how much profit is the firm is able to make, right? So when you go to balance sheet and you look at the equity number, okay, what is the total equity value here? The total of these three items: equity share capital, other equity, non-controlling interest. Non-controlling interest is also called minority interest. Minority interest. Okay, so all of these are part of your equity. And when I take a total of this, I get equity. So look at this. The total equity is, if you see the bottom of my screen, it shows the sum 62,000. On total equity, how much profit has the firm been able to make? So observe how I'm writing the formula. I'm writing the formula as is equal to, in the numerator, I'm going to take profit after tax or earning after taxes. Profit, earning after taxes use interchangeably, 15,000 divided by sum of, go to balance sheet and take a sum of these three items, because these three items is your total equity, bracket close, and then hit enter, and my return on equity is coming out to be 24.7%. That means on the equity that the firm has invested, there's a 24.7% profitability generated by the firm on a closing basis. Now, we generally take an average equity here, but we just have 1 year of data, so we can't do that. So we'll just work with closing equity, and that's okay. You can do that with certain type of companies. Are you guys okay with this? Net profit divided by closing equity. Let me show you one more time. I'm deleting this. I'm writing the formula again. Is equal to, go to income statement, select net profit, 15,503, which is in cell C70, divided by sum of SUM, bracket open, go to balance sheet, select these three items, bracket close, enter. And you'd have your 24.7%, which is your return on equity. Guys, are we together on this? Are you comfortable with how this is done? Okay. Next ratio is a little complicated. Return on capital employed. This is also called as ROCE, return on capital employed. ROCE metric. The formula is EBIT divided by total assets minus current liabilities. So why are you doing total assets minus current liabilities? What's the logic of this formula? How does the formula come in? Where do you get this formula from? So I'm going to kind of build some sort of a overview of this balance sheet for you, so you understand this balance sheet well. Okay. So if I take this ITC's balance sheet and if I try to simplify Sandeep, I'll answer that question, keep it on hold. If I take this balance sheet of ITC and if I try to simplify this, all right. So the simplification will look a little bit like this. This is my balance sheet. Here we will write down equities. Then we will write down outsiders liabilities. And then we will write down current liabilities. Okay. For equity, then I will write down something like long-term debt, long-term liabilities, and then current liabilities. Here I will write down, property, plant and equipment. Then I will write down other assets. Okay, other assets, and then I will write down current assets. Okay. Now this, what I'm showing you is very critical. So I want you to observe this carefully. Now, first thing that we'll do is we'll go and take total of all the equities. Okay, so total of all the equities here, this number 62,821. I'm going to round it off to keep things simple. So 62,820. 62,820. That's the total value of equity. Then we have this ton of financial liabilities here. Okay, all of these are your other financial liabilities, right? So I'm going to take a total of these items. The total of these items is 2273. It's visible. I don't know if it's visible on YouTube, but it shows at some, right? 2273. So I'm going to write this as maybe 2270, just to round it off. 2270 is my long-term debt. And then everything that I have below this is my current liabilities. So these are my current liabilities. Okay. Please just give me a minute. I'm getting a super important call. Just 1 minute. Okay. Sorry, guys. Yeah. So these are my current liabilities here. Let's take a total of these current liabilities. So total of these current liabilities is 12,160. Okay. So all of the current liabilities is 12,160. All right. So let's write down here. 12,160 here. And then we will take a total of our balance sheet. I'll probably keep a calculator handy here. So it will not match precisely, but it will match approximately 62,820 plus 2270 plus 12,160. So total is coming out to be 77,250. Okay, so this is my total of equities and liabilities here. Is it matching with the actual total? Yeah, we're fairly close, right? The actual total is 77,259. We've got 250. That's okay. We've just done some rounding off. Then we'll go and start looking at assets. Okay. So property, plant and equipment, that's about 20,200. So I'm going to write 20,200. Then I'm going to take all the assets that the firm has. I'm going to take all the assets that the firm has, all right? Everything else except current assets and take a total of them. So starting from capital work in progress up to the other non-current assets, total of all of these is 22,800 crores. Okay, it's 819 actually. Okay, so let me make it 22,820. 22,820. And everything that's left, is obviously your current assets, right? So let's take a total of all the current assets. So this is 34,230. 34,230. Let's take a total here. So 20,200 plus 22,820 plus 34,230. I'm getting 77,250. So we've taken ITC's balance sheet and really dumbed it down like a school kid. That's what balance sheet is here, right? It sounds very fancy, but at the end of the day, that's how you want to visualize it. Is everyone okay with me in terms of what we've done so far? Guys, are you comfortable with what we're doing here? Okay, I'm going to assume that you're comfortable with what we've done. All right. So here's how you want to visualize this. Look at this carefully. What you want to do now is you want to say, you know what, these two guys are providers of capital. Okay. So the capital in my business is coming either in the form of equity or it's coming in the form of long-term debt, long-term liabilities, providers of capital. This current liability is nothing but part of my working capital. So if you know what is the definition of working capital is nothing but the capital that you need for day-to-day operations of the business. So that's nothing but current assets minus current liabilities, CA minus CL. We do have current assets here, which is 34,230. What I'm going to do is I'm going to calculate what is my investment in core working capital. Okay. So 34,230 minus 12,160. I'm reducing current assets minus current liability. Let me quickly do this on the calculator. 34,230 minus 12,160. So my core working capital investment is 22,070. Okay. Now what I'm going to do is on my balance sheet, observe carefully. I'm going to delete the current liabilities here. I don't need current liabilities here. Okay, so I'm going to delete the current liability from this new. Okay, I don't know why my software is acting up. Just give me a minute. Okay, so current liabilities I've deleted. And here, I'm not going to write current assets. I'm not, come on, what's happening? I'm not going to write current assets. I'm rather going to write a simple working capital investment here. And working capital is 22070. The moment you learn to see balance sheets like these, right, you'd be able to build visualization on what's really happening in the business, right? Cut down on all the complexities and see what's happening in the business. Now let me explain what's happening in the business. ITS is running manufacturing, tobacco manufacturing, FMCG, hotels, paper. They're running a variety of different businesses. The total capital that they have generated, okay, from two sources. Which two sources? They have generated some capital from equity, some capital from long-term debt. Long-term debt is almost negligible. So total capital that they've generated is 62,820 plus 2270. Total capital that they've generated is 65,090. Okay. Out of 65,090, they've generated 62,000 from equity, 2270 from long-term liabilities. What are they doing with that money? That's how you want to learn to visualize balance sheets. What are they doing with this money? So they're taking this equity and a little bit of long-term liabilities, 65,000, out of which 20,000 they've invested into property, plant, and equipment, the core business. 22,820 they've invested into other assets, investments and whatnot. And another 22,000 they've invested in working capital. Working capital means capital used for day-to-day businesses. So this number is nothing but CA minus CL, right? This is how you want to learn to visualize this business. This is the true capital employed in the business. So if I take total of the right-hand side, 20,200 plus 22,820 plus 22,070, the total comes out to be 65,090. All right, so that's the total. This number is called capital employed. Now, when you look at the formula, it kind of sounds strange, right? This is the formula: EBIT divided by total assets minus current liability. But the question is, why are we doing this? Why are we doing total assets minus current liabilities? Because my total assets include current assets. And when I do current asset minus current liability, it gives me net investment in working capital. And how I want to see business is I want to see what is the capital employed in the business, right? The true capital employed in the business, 62,000 from equity, 2270 from long-term debt. And how is that capital employed? Where is it employed? Some part in PPE, some part in other assets, and some part in working capital. So this is the denominator, and then numerator is going to be EBIT. So let's come and write the formula here. So is equal to, observe how I'm writing the formula, EBIT 18926 divided by bracket open, balance sheet, go and take total assets minus sum of all the current liabilities, sum bracket close, second bracket close, and we're good to go. And there you go. This is your return on capital employed. This is how you calculate this number. What do you guys think? Uh, I'll answer that question in a bit, Mohit. Generally, ROCE is a number, and even ROIC is a number which we'll be learning, is done on operating profit levels. So, because it's done on operating profit levels, yeah, same question. Shamin and Mohit, you want to see the profitability on the operating profitability levels. Okay, and that's why generally EBIT is the numerator. Now, I want you guys to think like an analyst, okay? And I want you to tell me if there is some fundamental flaw in this formula. Do you think there's a fundamental flaw in this formula somewhere? Like, is there a fundamental flaw in the formula? Come on, tell me if there is a fundamental flaw in this formula. Okay, here's the answer. You want to think like an analyst and you want to tell yourself, what have I taken in denominator? I've taken in denominator PPE, I've taken in denominator other assets, I've taken working capital, right? So in the denominator, I've taken PPE, other assets, working capital. But in the numerator, I've taken EBIT. What's the problem with EBIT? The problem with EBIT is that EBIT does not include other income. Look at this. When I did EBIT, it's 18,926. No, when I did EBIT, it is 18,926. Can you see there is other income of 1836? What you've done is you've created a mismatch. Okay, what is a mismatch? In your denominator, you've taken total assets minus current liability. So your total assets include these investments, right? These financial investments of 12,000 and another investment of 12,000. These investments of 24,000 is what is getting you this other income of 1836. So denominator, you took your investments, but in the numerator, you did not take other income. So you've created some sort of a mismatch of numerator denominator, right? And that's the analyst thinking that you guys need to develop when you analyze companies. What do I mean by this? Let me repeat. When I look at balance sheet of ITC, especially on the other side, okay, I need to do some sort of an analytical adjustment. Let me show you how I'm going to do those adjustments. First, I'm going to go and I'm going to take the total assets that the ITC possesses. Okay, what is the total assets? Total assets is equal to balance sheet. Total assets is 77,259. Then out of this total assets, what is the short-term investment? Investment into stock markets, investment into mutual funds. What is the short-term investment? So is equal to, go to balance sheet and take short-term investments, which are here, 12,264, which is a part of your current investments. Okay. Then what is the long-term investment? What is the long-term investment that ITC has made? So long-term financial investments that the ITC has made is 12,307. Okay, 12,307. Have they made any other investment? Yes, there is also an investment property here. Okay, of how much? 364. So there's an investment property of 364. And then there is also investment accounted using equity method. So let's take both of these numbers. So there is a investment property and there is an investment accounted using the equity method. Okay, so these are the 4 investment items on the books. Investment property is how much? Investment property is 364. Okay, I'm just linking these numbers back. How much is the investment property using equity method? Through 69. So here's how you want to think of it. What you're thinking is, you're saying, my total assets are 77,000. Okay, my total assets are 77,000. But out of my total assets, these 4 items are not my core business. ITC is not an investment company. ITC is a manufacturing company. It's a hotels company, FMCG company. So this is not their core assets. So what I do is, when I calculate these ratios, I don't use this blanket formula. And that's the level of analysis that we want to learn. The formula that I use is the core operating assets of the business. Core operating assets. Now, what do I mean by core operating assets? Core total operating assets. Okay, core total operating assets. So core total operating assets is going to be total assets minus all the investment, because these investments is not ITC's core business. So this is the number that's coming out to be 52,504. So these are my core operating assets. Then we will take current liabilities. Current liabilities. Current liabilities we've already calculated. So just go to balance sheet and take a sum of all the current liabilities here. So current liabilities. Current liabilities, where are they? Here. These are all my current liabilities, right? So just take a total of them. That is this number, 12,163. Then calculate core net operating assets. Net means after deducting current liabilities. Like how we did that previous formula. Total assets minus current liability. I'm replacing total assets with the core total assets, core operating assets. Operating assets. Okay, I hope you're getting where I'm going with this. जो core business धंधे वाले assets है वो लेना. You want to take the core business assets of the business. So when I do net means I'm going to deduct current liabilities. So this number minus this number. So that will be 39,890. And then I will take the core operating profit, which is nothing but EBIT. Because when we calculated EBIT, if you guys remember, we did not take other income. We put other income below EBIT. Look at income statement. We started with EBIT, we put other income below that, right? So then go here and just bring in your EBIT number. And then go to income statement and link your EBIT number here, which is 18,926. And then you calculate return on core capital employed. Okay, this ratio is also called at times adjusted ROC. This ratio is also called adjusted ROC metric. And these are the things that you learn beyond textbooks, because when you learn textbook, you just look at the formula, but you always want to adjust them carefully. And what would be the number here? So in this instance, operating profit, core operating profit divided by core capital, and the true return on capital for ITC is 47.4%. That's how you want to think of it. Right? And then On the surface, had you used a simple textbook formula, your number would have come out to be 29%. But you do adjustments and you figure out, you know what, the true number is 47.4%, which means whatever capital ITC is deploying in its core business activity, not in investments, on core business activity, on that capital deployed by them is 39,890. And on that 38,890, they're able to generate a core operating profit of 18,000. So that gives you a return on core capital employed of 47.4%. Understood? Okay. So we still have to do, more ratios. I don't think I'll be able to finish them. We're still on profitability. I have to do ROICs with you. And we have to do some working capital ratios, liquidity ratios, some debt related ratios. So we'll do them in the next session. Okay. So next session, we will spend maybe an hour on completing ratios, and then we will start with the company that we're going to do. Remember, next session onwards, it's going to be only on Zoom. The ones who've already signed up, my team will reach out to you. They'll share the Zoom link. If you do not receive the Zoom link by Thursday next week, you can reach out to FinTree admin team. They'll share the link with you. We'll create a WhatsApp group on the first class, and then we're good to go. Okay, so I'm done with my session today. As promised, I'll keep last 10-15 minutes for Q&A. I'll also share this file in the interim. You can keep on posting your questions on the chat box. I'll try and answer them if I can. In the meanwhile, I'm going to share an updated file for you. Keep on posting your queries on the chat box. I'll try and answer them one by one. All right, here's the link. You should be able to download the revised Excel file. So, keep a copy of it and then try and practice yourself. All right, let's do some queries. Inder, Suraj says it's a paid one. Yes, Suraj, it is. Inder, hello sir, I do not have any financial background. I wanted to learn financing for two reasons. Learning for investment purpose. On long term, I plan to do CFA. Do you think this class course is the right step, provided I complete accounting basics as you mentioned? Yeah, it's a good starting point, Inder. Just make sure you finish level 0 and you finish the foundation. You finish the basics of the foundation course that we have within financial modeling. You should be okay. You should, even if you've done level 0, I think you should be all right. How shall we reduce the decimals and put some commas to better visualize thousand hundreds? Shamin, you can do number formatting. Control Shift $ will, put them into a number format. See, what you can do is go to cell and do Control Shift tilde 1, 2, 3, 4. Just keep on experimenting. You get different number formats there. Josefa, not that I'm aware of. How to sign up on the FinTree India website? You took EAT for calculating ROE, but EBIT for calculating ROC. Correct, Swapnil. So Swapnil, ROCE as a metric is generally done on operating profit level, because what you want to do with ROCs is you want to compare companies with different capital structure. one company with high equity, low debt, second company with low equity, high debt, you should be able to compare them. That happens when you can do that when you're comparing them on a ROC level. The moment you go on a net profit level, net profit is affected by interest. So then, it's not apple to apple comparison. Therefore, ROC is generally done on EBIT levels. Can one pay an installment? I'm so sorry. Is this just talk to FinTree team? I'm not really involved in operations, so my team should be able to assist you with it. My question is similar to Inder. If there is anything confirmed cohort coming up towards the end of this year, then it's better for me as I'm going through some engineering licensing exams. Shamim, I can't really make a commitment. I don't run financial modeling on a structured basis. It's more of a passion project for me. So I don't know if I would do one in October, November. I may or I may not. But then you can always do pre-recorded videos. It does not have to be live. You get access to the same content, so you can always view the video and learn it by yourself. And you get access to almost 7-8 different financial models. A lot of different variety of companies. So you can learn through it. Okay. Any other questions? I'm waiting for you. What are the job opportunities? I'm guessing you're asking specifically from financial modeling perspective, right? So see, modeling is it's a very important skill to have in certain sectors within the financial industry. For example, investment banking, right? Especially middle office investment banking, you kind of need to know how to build, even front office, certain profiles. You need to know how to build your financial models. You need to know how to run valuations. Then equity research, of course, buy side, sell side, both you need financial modeling. So financial modeling in general is a highly valued skill. We like on FinTree placements, we keep on getting requirement of candidates who are hands-on on financial modeling process. So there are always jobs available for financial modeling, but just having a certificate is not good enough, right? Like a lot of people have this approach that I'll get a certificate, put it on my CV, and I'm done. I don't think it works that way. What you need to have is a real skill. Right? You need to be really good at what you're doing. So if you're going to learn financial modeling, I would say that jump into it and be really good at the entire process. Not just learn the Excel, but also learn the thought process, the thinking pattern. Read books and devote yourself to learning. There are plenty of jobs in the market. I don't think sitting here in 2022 getting jobs in financial industry in India is tough. In fact, we are in a unique situation at FinTree where those of you who are on FinTree placement broadcast would have realized this. We're getting more opportunities and we have less candidates now. It's kind of strange that we've more number of opportunities and less candidates. So I think you would be able to handle this easily. How many sessions? Again, I'm not sure. It really depends on how things flow, but generally somewhere between 15 to 20 is a decent ballpark. 15 to 20. Mohit, the answer is yes. If you're a CFA candidate and if you've already written level 1, I think it's a really good idea to kind of get hands-on on financial modeling. Tomorrow morning probability, yes, Aman. That's correct. Huzaifa, yes. Shamin, are we going to do some project modeling, real estate project? No, Shamin, we wouldn't be doing any project modeling per se. Though in your class, again, I'm not committing it, but I'm talking to a consultant who basically does work on M&A modeling deals. Very senior, reputed firm in the world. And I'm going to try and invite them for one session with you to show you how merger modeling works, especially synergy calculations and all of it. I mean, the process is same, what we learn, you just extrapolate that in a different context. So you might get one bonus session from on merger modeling. If you guys insist and if all of you want to learn on real estate, we have resources. I can probably pull in one subject matter expert on real estate modeling as well to help you if that's what you, if all of you really need. Okay. All right. It looks like questions have dried up, so I'm going to take you leave. Okay. Sandeep has some questions here. Let me answer Sandeep's query. Why you also included non-controlling interest in total equity? Because the share company does not own. Sandeep, minority interest is a part of equity because we take subsidiaries, all the assets, and we treat them as our assets, right? So in a consolidation process, now it's a slightly technical question, but I'll see if you can understand this. When I'm doing consolidation of companies, I take subsidiaries assets, I treat them as my assets. I take their liabilities, I treat them as my liabilities. So I treat their shareholders as my shareholders. That's why that minority interest or non-controlling interest is a part of your total equity. All right. Thank you very much. I will see you next class. First 1 hour, we do the ratios, and then we will start with the company that we are going to model. If you're curious to know which company we're going to model, the name of the company is, the name of the company is RateGain Travel Technologies. Many of you might have already guessed. It's an interesting SaaS company, and SaaS is a very interesting space. I started studying this company about right during their IPO. It's a recently listed company. It has taken quite a bit of hit on its stock price, but I really love the business model. In fact, I feel these guys have a lot of potential, at least on the face of it. So we'll be spending, we'll be reading the whole prospectus of this company. We'll be reading prospectus word by word. We'll be understanding, and it's with travel technology, and I think it's going to be interesting learning curve because I've never studied travel as an industry, travel and hospitality. So we'll get to learn about this online travel agents, like booking.com and your Make My Trip and Skyscanner and all of those, those category of guys. These guys also use a lot of machine learning and artificial intelligence. So overall, I'm quite excited. I think it's going to be a fantastic learning curve and maybe a fantastic investment opportunities as well. Okay. All right. With this, thank you. I'll see you next Saturday, same time on Zoom.